Hi, I'm Richard Purnell from the Mortgage Home. We are your buy-to-let mortgage experts. Now, this is your December mortgage update on everything to do with the buy-to-let mortgage market that's happening right here, right now. Now, just before I get into the content for December, I thought we'd have a single question quiz. And to understand the question, I'm going to ask that at the end of this presentation. So get your pens and paper ready. Single question. If you want to enter to win a prize, what you got to do is put the answer to my question on the comment section under the video on our YouTube channel. And the first person that gets the question right is going to win a money can't buy prize. Yeah, or maybe not a money can't buy prize. It's probably about 12 quid on Amazon. However, the point is, it's a book. It's the first book I ever got on property, and it without trying to overstate it, it actually changed my life, my perceptions about what people were doing to become financially free, how they were doing it, and it was done in such a way that actually even made sense to me. And it's something that I thought might be worthy of you guys having a read of. So keep this the video going right through to the end, and see what the question is, and hopefully one of you will win that particular book. Okay, let's get on with the content. And what's the market watch for this month? As always, we start with the Bank of England rate. I see interest rates are rising. I see trouble on the way. Now, that's not the most profound thing I've ever said. We all know that rates are going to be going up, but the two questions that people are asking me are, when are rates going to go up and by how much? So, well, we probably do need a little bit of a crystal ball for this, as always. There was a lot of talk it was going to go up in November. It didn't. Will it go up in December? Have those pressures gone away? No, they haven't. But here's my personal take on it. Even though these economic pressures are still there, with inflation, with employment, the thing that may make the Bank of England committee defer a decision, and I am mindful that at the time of recording this, we're only a few days away from the Bank of England meeting, is, and I hate to bring COVID into what should be a very positive conversation, but the latest variant, there's so much uncertainty, I think, about just whether it will gather pace and whether, in fact, the government will start to impose further restrictions. In the last 48 hours, certainly up to me recording this, the government are now asking people to work from home. So there, I think, could be a concern that there could be further steps that have a negative impact on the economy, and the Bank of England might then hold fire into the new year to see how that plays out. So that could be one thing that defers the almost inevitable rise. Now, the other thing that we have to look at to get maybe a better prediction is the Bank of England do their own forecasts of where they think the rates are going. So I took a look at this, and over the next 12 months, they are saying that rates are going to go up by about 1%. So they don't do these forecasts on quite on a month-by-month basis. So we're not going to say, oh, it will definitely happen on this particular month. So maybe we're probably splitting hairs. We know rates are going to go up, highly likely, and the Bank of England are saying by probably 1% by the next year, and then flatlining for another couple of years, interestingly, after that. So that's our view on that. But in actual mortgage land, rates are already on the turn. So look, if you want to take a message away from this particular point, is if you have any mortgages on standard variable rate, get your finger out, get them reviewed now, and see if you can actually get a better deal by fixing it. And the other type of mortgage you want to be looking at are those where the fixed deal is going to come to an end in its next 6 months. Now you might think, okay, well, 6 months, that's still a hell of a long way. I can't physically move. No, you can't. However, what you can do is lock yourself into the next deal today at today's rates, and then just sit on that, because mortgage offers, depending on the lender, can last for 6 months. So you can grab that best rate now and then wait for your deal to end, if that applies to you. Right, let's move on. Metro. Now, Metro Bank are a sort of London-centric, certainly southeast of a bank, so they do have a high street presence, and they're really pushing into the buy-to-let market a little bit more, and in a couple of ways actually. And one is that they've relaxed their calculation on how they determine how much you can borrow, to the point that they are now amongst the most generous lenders when it comes to buy-to-let lending based on your rental income. So let me give you an example. So if you went to Metro Bank last week under the old rules and the amount of rent converted to a borrowing of £100,000, so Metro said, yeah, maximum you can get, Richard, is £100,000 for this scenario and this amount of rental income. You go to them today with the exact same scenario and they'll lend you £114,000. So an additional 14% could potentially be released, so long as you're not going above your 75% loan to value, because the product maximum is 75%. And the other thing, as it says on my slide, is you've got to be taking one of their 5-year fixed rates. And if that suits you and you're within that 75% limit, then an extra 14,000 quid, that's on £100,000, then, or certainly an additional 14% improvement on what they lend you, is a big chunk of money. Now, many landlords, particularly newer landlords, so this is for aimed at you guys are just getting into this market or certainly fairly new to it. And this is where I see a lot of these newer landlords that sometimes get slightly distracted by being offered properties with high yields. You say, yeah, well, surely that's why we're in it. And by high yields, probably talking 10, 12, 13% yield. But the reason that some of these properties can achieve these high yields, and these are just normal family lets, I'm not talking about HMOs, multi-units, holiday lets, etc. It's a typical family let, excuse me, is because the price of the property, particularly up in the north of the country, northeast, Newcastle, Sunderland areas, and up in Scotland in particular, and specifically with flats up there. These are valued at quite often under £50,000, and okay, you can get, say, you know, rents of 450, 500 quid a month, perhaps, on such a cheap property. So it does sound attractive on the surface, but here's the thing: you can't remortgage them. When they're valued under £50,000, lenders don't really have appetite to lend there. There's very little profit in it for them. So you find as a broker that we will really struggle to find a suitable lender so that you can get a mortgage on that. So therefore you're having to buy these types of properties cash, which means everything's locked up. And that goes against surely many of the principles that you landlords should be adhering to. In my view, in terms of values, once we get over £75,000 as a minimum property value, that's where the lenders are coming in. That's where the appetite is, and obviously higher than that. And so I'd say that's where you guys should be looking as a minimum property value. Okay, who else has caught my eye? Accord Mortgages. Have you heard of them? Well, it's the intermediary brand name for the Yorkshire Building Society. And again, this is another fairly local building society, but they lend on a national stage. As a broker, we've known about them for many years, and they lend throughout the country. So we're comfortable in using Accord Mortgages for sure. And again, these are another lender that's got ambitions and are starting to try to lend more and get a slice of this buy-to-let market. And so they have quite recently, in the last couple of weeks, dropped their minimum income rule. So a little bit of, let's take a step back here. The vast majority of high street banks and building societies, if you want to put a buy-to-let application into them, will have this, I've got to say, it's an arbitrary minimum income that the applicant has to earn just to be able to apply. It has absolutely no bearing on the mortgage you're trying to get, the property you're trying to buy. It's purely some sort of quasi quality control. And it's a real blunt instrument. But anyway, most of the banks and building societies have this in place. And it's usually around 20 to 25,000 pounds. Accords was 25,000 quid. And you've got to be able to earn that from anything other than, believe it or not, profit from land and property. So you had to have a day job. You had to be earning in some sort of employed capacity or a separate self-employed position in excess of 25k, and that got you eligible. Okay, so that's the backdrop. This particular building society, one of very, very few banks and building societies have actually dropped that. So you don't have to tick that particular box anymore. So that is good news. There is the secondary market. So those are lenders who are not banks, not building societies. They usually don't have a minimum income requirement anyway. So it's not that unusual from a broker point of view, but it is unusual for a building society to scrap that. And linked with that, I also noticed that Accord are also starting to dip their toe into the first-time buyer market when it comes to buy-to-let properties. Now, this is, as a broker, it's extremely difficult when we get that type of inquiry where the buyer has never, ever owned a property before. And the first property they're buying is a buy-to-let. Lenders much prefer the applicant to have gone through and bought their own house to live in, and then the next property is a buy-to-let. That's the general rule. But Accord are saying, now they're saying it in a very fluffy way. So I don't think it's quite policy yet. Like I say, they're wanting us brokers to get a feel for what appetite's out there, what the sort of scenarios might look like. And if they feel it's a good quality case, it sounds like they're keen to lend for that sort of scenario. So again, good news, because right now there's very few lenders will allow that sort of scenario. Now, I've put Foundation on there. Foundation are a secondary lender, so they're not a bank, not a building society. Been around again a long time. As a broker, we know them really well. Now, this is on their residential side. And I know this is the buy-to-let update. Bear with me. I put it on there because we do get a lot of applicants who, the way they enter the buy-to-let market in the very first place is by releasing equity from their residential property. Not many of our landlords have got the cash, the savings to buy their first buy-to-let in that manner. It's already locked up in the equity in their residential, so they want to release it. Now, if you can do that from a high street bank or building society, you will get the better rates. But if for some reason you've got maybe a little bit of adverse, or your income situation is unusual, or you actually are not able to borrow enough for your needs, it doesn't release enough for deposits for your buy-to-let, then Foundation are saying, hi, we're over here, we'll lend 6 times your income. Now, how does that compare to the high street guys? Well, they generally go up to 5 times income. So an extra additional one. So if you're on a 50k salary, that's potentially another £50,000 of borrowing. Now, this is for professionals only. So Foundation do have a list of what their definition of a professional people are. So yes, there's hoops to jump through, but it might appeal to you. And the final thing, it's something I bang my drum about on a regular basis, but we're in that time of the year where we get landlords wanting to put an application. They've had an offer accepted on a property. We want to move quickly. We've agreed a completion date with the seller or the agent. And then I say, yeah, have you had your April 21 returns done yet? And we have this silence. Because they haven't, because legally, you don't have to do your returns until the 31st of January 2022. So the HMRC are not really pushing you as the landlord to do that. But the lenders have their own rules. And as a general rule, once we get beyond the end of September, and clearly we're now almost 3 months beyond that date, lenders will no longer use your April 20 tax returns as proof of income. So they will insist that you have your April 21 returns done. So going back to my scenario, you've had your offer accepted on your purchase and you haven't done your returns yet, then everything stops. The application stops, all gets paused until you can get those done. And, you know, if you use an accountant, it can easily take 2 or 3 weeks. We've got Christmas coming up. It could go into January and it could jeopardize your purchase. So one, get your tax returns done now. And the second point is put a diary date in for 2022 so that you get your returns in early to your accountant before the end of September 22. Stick it in for August 2022 to get your self-assessment done, whether you're doing it yourself or an accountant, and then they're done, ticked off, so that if you are buying, this isn't the thing that's going to hold your application up. Okay. Standout deals, as always, a little bit of a highlight. It's quite a busy slide. The first thing I put on, again, is another residential one. I've just put it on there really to get your views on it. I would really love any comments that you've got on in fact, anything I'm saying today. I'd be delighted if you put the comments under this video on the YouTube channel, so that I get a feel, some feedback really, as to the content we're putting out there and whether it's appropriate and what your views are. So certainly this slide is really pertinent. And certainly on this residential one, a 40-year fixed. We're all used to fixing for 2 years, 5 years. Some of our clients might fix for 10 years. Well, we've now got a lender that's brought out a 40-year mortgage. I know you need a crystal ball, don't you, to decide whether you would sign up to that one. But, you know, if presented with that, is 4.16 a good rate to hedge your bets for the next 40 years? Again, stick your views on there. I'd really be interested to know whether you think that's competitive. You know, would that appeal to you? Now, the final thing, just on this point, I did have a look at the detail on here, and you're actually tied in for the full 40 years. So that is a big commitment, isn't it? So I'm not sure there is going to be a lot of appeal, but again, I'd be interested in your views. Okay, back on to more buy-to-let stuff. HMOs, 2.29 for a HMO deal. Cracking headline interest rate. Be mindful, no free launch. There's a 2% arrangement fee with this, so just watch out. Limited company rates. Now they are dropping a little bit. Generally speaking, limited company rates for most of the year have been at the high 2s, and the fact they're coming down towards the sort of mid 2s, is that start of a trend? I think it's too early to say, to be honest. Yeah, I'm not too sure that it is if I was making a prediction. But however, 2.59, good rate. Again, though, fees attached to that. You know, I think you guys should be know. I say it on a regular basis. No such thing as a free lunch. Don't get too carried away with the headlines, but it is the sort of lowest rate for a limited company 2-year deal right now. Holiday lets, I'm going to say stubbornly stuck at the sort of high 3s, sort of 3.34%. With the uncertainty out in the market, with everything that's going on, COVID, etc., I do not see lenders slashing and burning these types of rates anytime soon. So get used to rates starting with a 3 with holiday lets. And if you're looking for more complex holiday lets and the bigger stuff, actually they're going to start with a 4, I would say. I'm not saying that's a bad deal at all, but that's just where those rates are for 75%. Now, standard rates. Now, a month ago, when I was doing this bulletin, I was still getting giddy about buy-to-let rates under 1%. They have now gone, so that does give you an indicator, even whether the Bank of England put rates up this month or in early spring. Buy-to-let rates are now just slightly on the march up, and the lowest now 1.14. If you're buying in personally, and that's what I mean by standard. Finally, on this slide, multi-property mortgages. Now, I do try and keep away from jargon on these presentations, and there are mortgages called multi-unit mortgages. This is not one of them, so I just need to explain really briefly so that I'm nice and clear for you guys where this might appeal to. And I do think that this is going to appeal to a lot of our landlords. Let me explain why. So multi-property mortgage in this scenario is where you are bringing two or more properties to the lender at the same time, whether that's a purchase or a remortgage. To be eligible, you're just doing two applications at once. So nice and easy. That could be two HMOs, it could be two family lets, it could be two multi-unit properties, doesn't matter. And assuming you meet all the other eligibility criteria, they're doing a 5-year fixed at 2.98. Now, the astute of you might be going, hold on, Richard, that's not that clever. Look at the other rates you've been quoting on this same page, 2.5, 2.29. Well, the thing about this 5-year fixed rate is it comes with a free valuation. It's got a 0 arrangement fee. That's the beauty in all this. And if it's a remortgage, it's free legals. And the additional thing with this one is if you are buying or you're remortgaging property that's in a limited company name, to get free legals is massively unusual. Lenders will nearly always charge, even on a remortgage, if it's in limited company, generally seeing that they'll pass on the conveyancing cost to you as their landlord. This one, no charges. I've got to put a caveat in. Look, it's got to be a straightforward remortgage. If you are doing any sort of transfer of equity, if it's a leasehold property, or if there's anything quirky or a little unusual that means that the conveyancers have got to do a little bit of extra work, that charge might get passed on. So we are talking about sort of straightforward stuff here. But honestly, that could appeal to lots of people, to the point where I just now want to spend the next minute or two just doing a little deeper dive into this type of mortgage so that you understand it a little bit more. So the first thing you can see is that, let's say you are now one of our sort of bigger landlords and you own a large portfolio where the mortgage deals are coming to the end at the same time. You know, you could refinance up to 30 properties. We're doing a purchase for a landlord for 8 buy-to-lets right now. So that this is our maybe more experienced landlords or more ambitious landlords who are, rather than buying in ones and twos, they're buying in multiples because they want to achieve their goal quicker, and they're in a position to do so because they have the deposits available. Well, in that scenario, this type of property, 2.98, yes, it is 5-year fixed, and you've got to be comfortable with that. If you much prefer the 2-year fixed so you can review things, well, okay, you're not going to get necessarily this deal. When your application goes in, you cannot mix and match the applications. So if you've got, for example, a HMO and a normal family let coming to the end of the deal at the same time, that doesn't meet the eligibility. It's got to be the same type of let. But what the advantage is, well, you get one mortgage account. It's one direct debit. It's one statement. When the application goes in, instead of doing 5 individual applications and 5 assessments and the process of 5 applications, you just have the one application. So it's extremely efficient from that point of view. Therefore, the underwriting is going to be much faster because you've got one underwriter looking at all 5 at the one go. Now, other things that make it appealing is that, again, because this may appeal to our larger sort of landlords with bigger portfolios, they don't care how big your background portfolio is, whether you've got 10, 100, 200. Our largest landlord has got over 200 properties. Happy days. They've got no issues with the number of in your background portfolio, which many, certainly the high street guys, all put a restriction on your background portfolio numbers. Also, no minimum income, which is not unusual with a secondary type lender. I think, well, I touched on it earlier with accord mortgages. When you talk about high street banks building sizes, as I said, they generally do. This guy doesn't. And I've already said that it's available for purchase or remortgage. So, yeah, could well be appealing for you guys. Okay, just as we're starting to move on now, I always do a little piece about insurance. It's so important for not only for landlords but homeowners generally. Now, I was speaking to our protection team earlier this week, and I was asking them what was the most common issues that they were finding when they were talking to clients and landlords about existing policies. And they came up with these three things that I've got here on the screen. They were finding that when they were having a look at someone that said, look, I've already got a life insurance policy, I don't really need anything new. But we said, look, let's have a look at it. There's absolutely no cost, there's no fees involved, and we'll just give you our view on it. And we've been finding far too often these three common themes appearing. First of all, the term on the protection policy is just too short. The protection was ending well before the client was going to retire, or for some of our landlords that have got property plans where they would have achieved their level of financial freedom, for example, where perhaps you can argue that you don't need an insurance policy from that point on. And so for some reason, their terms were just well short. And it's not with terms, it's not as simple as ringing your insurer up saying, can you just extend my mortgage, my life insurance term by another 5 years or 10 years. You do start again. It's a complete new medical underwrite. But we're finding that so many clients had this mismatch where they were unprotected for a period of years between the policy ending and retirement. So, clearly people are at risk at that point. The second most common point that we found was that the amount of cover didn't even pay off their current debts. Because when you took the original policy out, it may have covered the mortgage balance 10, 15 years ago, but life doesn't go in a straight line. It's taken so many turns. People have moved houses, maybe they've got larger mortgages, or you've just got certain more debts than you had when the original policy was taken out for whatever reason, but you've never thought to revisit that insurance policy. And so you're underinsured. So again, you're at risk. And, with life insurance in particular, generally speaking, it's so cheap. Fit and healthy people, £6 a month for £100,000 of cover. It's cheap as chips. So it's not difficult to get yourself adequately covered to pay off your debts. So that's the second thing. The final thing. Now here's a question, and I think this is probably the most important question, and the one where we're finding more clients have got this gap. Yes, you may have cover to pay off your mortgages. But let me ask you this question. If you were the person who was no longer here and you've left your family behind, and yes, there is some life insurance to pay the mortgage off, but could that remaining person and children and maintaining a decent level of lifestyle, could they still afford to stay in that house and pay the bills, even though there's no mortgage to pay? And that's the bit that I see again and again gets missed. They think, well, I've got life insurance, but if that remaining spouse, family member, partner couldn't stay in the house anyway, couldn't afford and still had to sell up and downsize, then we're not doing the right thing. We're not giving peace of mind to the remaining family should that worse happen. So do you have an insurance policy that also gives a lump sum or a recurring monthly annual income so that they can stay in the house, keep the kids educated, pay the bills, and maintain a certain level of lifestyle? And that's the other question I think is very worth asking. Okay, just to wrap it up now, as usual, quick slide on the other services that we offer. I'm not going to go through them. Do take a quick screen print if you want of that. And for those of you that felt they want to have a review, Like I say, it's completely free, no obligation. We've got our mortgage broking team, we've got our protection team. You can click on the link here or just copy it into your browser, and that'll take you through to our diary and have a chat with the team, and they'll be delighted to guide and answer your questions. Other than that, we've come to the end of the video, and if you're still with me, fantastic, congratulations, which means we're back to our quiz question. So now you heard my incredible guitar playing a little earlier in the video today. Now, did you recognize the tune? It's a very famous song back from 1969. So I want you to name the song and put it in the comments under the YouTube, on our YouTube page here. To give you another clue, it was also one of the songs from one of my favorite films, American Werewolf in London, that released in 1981. So I need you to name the song from my amazing guitar playing from a little earlier on, and you will win what is my favorite book. It's Rich Dad Poor Dad. If you have read the book before but haven't read it for a while, I would urge you to reread it, and then when you've read it, you know, pass it on to someone that's thinking of getting into property. It might be just the best thing you've ever done. Other than that, listen, thank you so much for listening and watching this video. If you like what you're hearing, do click the subscribe button if you've not done before, because we are going to be putting out in January onwards some more smaller bits of content that I'm hoping you're going to find of use. Other than that, listen, have a great Christmas, have a relaxing Christmas. I hope you get to spend that with your family. And remember, be educated and be successful.